On the life company side, we have not seen much, either any changed interest in terms of what the regulatory agencies are looking for, or heightened awareness. So overall, the life company portfolios have held up very well, commercial real estate.
So, Jim, how about the banks? What do you see in there?
In our world, it has been somewhat dramatic. I think we, like most of the banks, have tried to really sort of insulate and keep that fairly away from the eventual our clients. But within our review and approval process, we probably certainly have added, I would say, time and dollars with different additional layers of review, more validation having to, on where we would have risk rated both the credit facility and the borrowers in the past, have gone under a couple different revisions, and those are constantly being looked at more and more closely, a lot more scrutiny. What that has tended to do, where back in 06, 07, our sheet and outline where we would say 75% loan to value and DCRs of 120 or 125, a lot of those numbers have not changed. What has changed is that the reality is for us to get to those numbers has become much, much harder. And so, yes, we say 75% maximum LTV, and where we used to be up against that number on a more regular basis, probably the comfort zone of what it gets approved ends up looking more like 69 and 72%. And so the DCR, in terms of instead of just only hitting the 120 number, you're looking for something that exceeds that by some increment. So definitely the federal regulatory environment on the commercial bank is very intense. I would say that on our side, I don't want to call it the black star or the death blow, but it probably gets close to that, particularly if the lender was another regulated lender that the property was returned to or the foreclosure occurred on. You know, the traditional 5 C's of credit quality in terms of the fifth is character, and so we will depend heavily in terms of how the borrowers, how they conduct, how they act when things don't go well. So I would say, I only say from our standpoint, from within the bank, I would think it would be very difficult for that borrower, depending on how the default or how the turn of the property went, whether they would find much of a reception back at our, the particular. Maybe down the street and there's other stories, but I still think that it's a major issue.
We've seen more and more money coming in from outside with new acquisitions. We have financed a handful of those. We tend to do them at very conservative leverage levels. A component of our program is typically a piece of recourse. We consider those loans to be effectively non-recourse. And so when we do them, it's sub 50% loan to value, usually on a concurrent purchase price.
November, I closed a transaction with a gentleman from China. He resides in Canada, but he doesn't have a Canadian citizenship or U.S. citizenship. And he was making his first acquisition on an office building here in Fremont. Actually, it's on my newsletter there. And that was done with a union pension fund, non-recourse, 10-year loan, 25-year amortization, about a 4.5% interest rate at that time.